Hi, welcome back. You're watching MF Corner, and this Diwali we have decided to take a more methodical approach to wealth creation. So if you're thinking of a goal along the lines of creating a wealth of 10 crores over the next 20 years, we're bringing you two approaches. Before the break, Manoj spoke about how to build an aggressive portfolio to cater to this. Now, Prableen Bajpai, founder of FinFix Research, joins in to talk about how to achieve the exact same goal but with a moderate risk profile. Hi, Prableen. Thanks very much for joining in. So first up, tell us what exactly is a moderate risk portfolio and what are the kind of combinations that are possible here?
Good afternoon, Sumaira. So as Manoj spoke about aggressive investors and opposed to aggressive investors, moderate investors are typically in middle of the road risk takers. So they are okay with the fact that there is volatility in the markets and markets go up and down, but that is to a point. And beyond that, they seek stability in the portfolio. So a typical approach is the combination of linear and non-linear compounding, where we have fixed income products, bonds, as well as equities in the portfolio. And the two popular combinations when we are creating a moderate risk portfolio or a balanced approach portfolio are a 50-50 and a 60-40 approach. So 50-50 is typically 50% allocation to equities, which are our growth assets, and 50% to fixed income products. And in the 60-40 combination, we are taking 60% exposure to equities, stocks, and a 40% exposure to our fixed income products. And Sumaira, here for our calculations, I'm taking the 60-40 approach. And within the 60-40 approach, I'm taking the return expectations from equities, the 60%, what we would allocate at 12% annualized returns. And I'm taking the fixed income returns expectations at 7%. And when we combine this, we are looking at a 10% return on the overall portfolio for our moderate risk investors.
Okay. So Prableen, for an aggressive investor, I can imagine that 10 crores in 20 years, not a big deal. It's quite doable, like Manoj mentioned. But is it equally doable for somebody with a moderate risk profile? Because naturally you're trying to invest in, even within the same universe, you're trying to invest in a little more safer or stable or consistent kind of products.
Absolutely, Sumaira, it is doable, and we have three approaches here. So, of course, it's comparatively more daunting as compared to the aggressive investors' portfolio, because their return expectations would be higher. The first approach would be at an aggressive investor, let's say with 14-15% returns. Like Manoj mentioned, an investment of about 50 lakhs or 70 lakhs would be good enough. But for our moderate risk investors, this initial investment, if only a lump sum approach is taken, it will be about 1.5 crores. So if 1.5 crores can be set aside today and it can be just left, so 20 years from now at 10%, you get those 10 crores. But of course, it's easier said than done. So this lump sum in itself can be broken down into tranches. So it can be something like 12.5 lakhs for the initial 5 years, followed by 15 lakhs for the next 5, and probably somewhere about 25 lakhs for the next 5. So about a 15-year investment horizon. So that's the first part, if you're only taking a lump sum approach. But then this can come in combination with an SIP as well. So let's just take a look at how SIPs can work in isolation first. If you're just looking at an SIP investment, then with 10% returns, we actually need about 1.3 lakh investment per month, a SIP of 1.35 lakhs, out of which about 81,000 would go into equities and about 55,000 would go into fixed income, which would be your PPF, EPF, and your debt funds. So again, it's a big ask. It may be doable for a couple of people out there, but of course, it is tough. So here, the burden can be reduced a bit by bringing in step-up SIP, where with an investment of about 60,000 in the first year, and then we increase it by 10% the next year. So next year, we do an SIP of 66,000. And by the third year, we are doing an SIP of 72,000. So by the 20th year, Sumaira, we are actually doing a SIP of 1.74 lakhs, 1,74,000. And that can also get us to our portfolio target of about 10 crores.
Okay, but the approach you recommend is the mixed, right? Lump sum and SIP together.
Yes, and I think, Sumaira, because I think none of us would have those sort of cash flows, so easily, especially if you're in your 20s or 30s. It may be doable for those who are more set in their careers in their 40s and are actually looking to build their retirement corpus. And again, even lump sums actually come, let's say, in the form of your annual bonuses. It can be, part of your fixed income savings, which been done earlier. So I have worked out a combination, I feel, which may be doable for some investors out there, wherein they start off with 10 lakhs for the first 5 years. So they're investing 10 lakhs every year, 5 years, followed by 15 lakhs for the next 5 years. So the lump sum investment is only for 10 years. And Sumaira, here in combination with a step-up SIP, wherein they invest only 30,000 a month, the next year it goes to 33,000, then 36,000. This combination can get them to the 10 crore figure with a very moderate risk portfolio at 10% returns. And I think this can work best, but there are various permutation and combinations which can be done with the help of the math based on the individual's, their own situation.
Right. So Prableen, in terms of recommendations, what do you suggest in terms of equity and debt both? Where can or what are suitable investment opportunities?
So, of course, government schemes like EPF and PPF and Sukanya Samriddhi, they are wonderful. Of course, they have their own limitations with the amount which can be invested, but they're all at 7.1, 7.6 and 8.1% currently. Along with that, Sumaira, we have wonderful products like target maturity funds now within the debt space. So part of the lump sum can be done. And I think we recently had a launch of a 15-year target maturity fund as well, which is giving about 7.7% returns. Along with that, debt funds, I checked the returns for a monthly SIP of short-term funds, and so all of them have been in the range of 7 to 8%. So I think a combination of these with the fixed income basket and for their equity exposure, I would definitely advocate a combination of active and passive funds. I think passive funds for large cap and mid cap, and I think that can be filled in the remaining with a small cap, a multi cap, or a flexi cap active fund. And I think this can get investors to their target amount without taking too much risk.
Okay, so basically that's two approaches. Prableen, thanks very much for joining in. We wish you a very happy Diwali to you, your family, and all of your colleagues. And thanks very much to Prableen and Manoj for bringing us these two approaches this Diwali. So basically, wealth creation is not tough. There are very doable methods out there. Maybe this target was a little too aggressive, but then you have to start somewhere. Depending on your situation, you may choose the target and the time frame. But the whole point is that, asset allocation is a step-by-step kind of process which can actually help you achieve any kind of goals if it's done the right way. Thank you very much for watching. A very, very happy Diwali once again.